Good afternoon. My name is Shawn Hirsch, and I'm a partner with Signet Financial Management. I want to personally thank each one of you for joining today's call. Today, we have Steve Tuttle, Chief Investment Strategist of Signet Financial Management, discussing what may lie ahead for investors after the election. Steve has been with Signet for about 20 years and has about 30 years of industry experience overall. He's a great resource for our clients, as many of you know, and I hope you find this webinar informative. In speaking with my clients, I know most recent U.S. elections have caused a variety of emotions. I hope that this webinar brings some clarity to what we can control and why having a plan is so important. Steve will present for the first 15 minutes or so, followed by a brief question and answer session based on the questions that were submitted prior to this call. You will remain muted during the webinar for better audio reception. And if you do have any questions, I encourage you to reach out to your advisor or to Steve following the webinar. Steve, I'm now going to turn it over to you, and thank you.
Thank you very much, Shawn, and thank you all for joining us today. Well, it certainly has been an interesting year. We've made it through so far, and now I can happily say we are post-election. And what does the world look like right now? Well, from a government point of view, it looks like Biden is our president, so we're planning on a Biden win, and a divided Congress. So it looks like Democrats are going to remain in control of the House, and the Republicans will most likely control the Senate. There's still a little bit of uncertainty remaining. There's recounts, there's legal challenges bouncing around, and there's a potential runoff on 2 Senate seats in Georgia that could impact the balance of power in the Senate. So what does this mean? Well, there's a few implications that we can draw from this divided government scenario. One, we expect perhaps less dramatic policy changes. That might mean smaller fiscal support and no or low tax increases. On a more positive note, there is hope for more bipartisanship, and perhaps a small infrastructure bill is something that we could see. There seems to be common ground for that. So in terms of the markets, they're responding well to this scenario. We've seen time and again that elections don't matter that much for markets. And there certainly seems to be less concern about the specific outcome, who won or lost. And markets have rewarded investors once again for staying invested through periods of volatility, for staying invested through the elections. This week we had very positive news on the vaccine front. On Monday, Pfizer and its German partner announced very positive news on its potential vaccine for COVID-19. The results were very promising, with an efficacy ratio greater than 90%. That's better than the common flu shot. And following the positive news, the markets soared on Monday. And let's talk about markets. Let's look at what they've done recently. And this is a 3-month chart of the U.S. stock market. And if I drill down on it, I've highlighted some areas, some patterns that I wanted to discuss. So for the first few months, September, October, markets were in a fairly wide trading range. There was a lot of uncertainty in the markets. There was some concern about how the elections were going to play out and the COVID virus. And the markets went through a period of consolidation. So they were high, they were low, they were high, they were all over the place. Just prior to the elections, there was a pre-election rotation, and the market was pricing in the blue wave scenario of Democrats gaining control of all aspects of the government, the presidency, the House, and the Senate. And markets went down overall, but a lot of it was rotation from some of the areas that have done the best this year. There was some profit taking ahead of the elections, and some of that money rotated into value stocks, smaller cap stocks. When the election results came out and the polls were wrong. The elections were a lot closer than originally expected, and the scenario of a divided government became real. And we saw a post-election rotation that back into those growth stocks, back into the stocks that had done the best. And there was a dramatic move higher. In fact, it was the best week after elections since the Great Depression. And then just this week with the Pfizer news, we've seen what I'll call a vaccine rotation, where hopes of the economy reopening are coming back. And you saw a dramatic rally in some of the areas that have gotten hurt the worst. Think airlines, entertainment, leisure stocks. And again, some of this money came, again, out of growth stocks, out of technology, into the stocks that had underperformed earlier in the year. So if we look back on history, take a step back, what can we normally expect at the end of the year? And the reason we present this chart is because it shows that in November and December of every year, markets tend to go up. The averages say the markets are higher in November and December. And if you compare election years, which is the light blue, compared to all years, which is dark blue, the returns are very similar. And so that just reinforces that maybe the stock market doesn't care so much about who wins the elections. So I talked about a lot of the volatility, the knee-jerk reactions and the whipsaws that we saw in the markets. Well, what are the implications? What should we really be focusing on in this divided government scenario? Well, one aspect is that volatility is easing. We've moved past the election, so that source of uncertainty is off the table for now. That results in more normal volatility levels. It doesn't mean risk is gone. It doesn't mean markets won't go up or down. It just means perhaps it won't be as dramatic as we've seen in the last few weeks and months. In terms of yields with divided government, we can expect interest rates to stay lower for longer. We think interest rates are going to remain range-bound for many years, and the Federal Reserve has reinforced that belief. This does strengthen demand for income. With savings accounts and CDs yielding next to nothing, it is more important to get more creative and take a little bit of risk in seeking yield. And then finally, the vaccine becomes the most important driver of markets, we think, for the next 6 to 12 months. The economy needs to reopen, and parts of the economy are anticipating it. They're counting on it. And so how that plays out, in our opinion, is going to drive sentiment from here. Within this environment, there's some risks, there's some opportunities. Let's talk about some of the opportunities. With the scenario that I'm describing, you could see opportunities in areas of the market that haven't done as well recently, areas that represent value. The opportunity to buy assets at lower prices is attractive. And the assets that I'll highlight here are small and mid-cap stocks that haven't participated in the rally as much as large-cap stocks. Value stocks in general have lagged growth stocks, and foreign stocks as well. I'll include in that in terms of lagging U.S. stocks. It doesn't mean we want to give up on growth. We do think that this environment is going to continue rewarding the best companies that can generate sustainable profits. And there's a lot of those companies in the technology sector. We'll also highlight healthcare sector. Those are two areas where innovation and growth is real. And there's some very powerful companies that are changing the way we live our lives. And so you do want to have some exposure to those types of companies and sectors. Large caps, quality large caps that are able to generate profits, sustain those profits, and do it absent a lot of debt or stress when markets slow down are going to continue to be important in portfolios. With the new president, perhaps foreign relations will improve, and we'd point to emerging markets, specifically Asia, as an area of opportunity. China is a powerful part of the global economy, and emerging markets in general are cheap relative to history. And that could be an area where we see some nice upside potential. And finally, in terms of the search for yield, the need for income, credit markets are going to continue to be important. There's a lot of investors who want and need income out of the portfolios, and you can't get it from hiding in the savings account. So corporate bonds, municipal bonds, anything that generates income is going to be in demand in this environment. Overall, I can sum it up by saying we do have a positive market outlook. There's three main points that we're focusing on. One, the economic data is encouraging and improving, and stock prices are strong. They're near all-time highs. Put the volatility aside, at the end of the day, stock markets are near highs, and they're behaving fairly well. Fiscal and monetary support. There's a lot of support coming from the Federal Reserve to keep markets liquid and to keep money flowing. And from a fiscal point of view, Washington has already committed a lot of money to helping companies and individuals get through this COVID pandemic. We are expecting another policy sometime, maybe even during the lame duck session, but if not then in the first quarter of 2021. This should lead eventually to the easing of lockdowns. Progress on the COVID treatment and the vaccine is going to dramatically help the economy. Whether it's 3 months, 6 months, 12 months is uncertain, but we are counting on an eventual easing of lockdowns. Fundamentally, and this is a very important driver where markets go, fundamentally, corporations are beating expectations. They are trending up aggressively off of very low levels. And what that means is that when COVID hit, many companies, their earnings took a serious hit. Earnings for the S&P 500 dramatically dropped. They stabilized, and now they're recovering. And we expect to see that recovery continue more and more as the economy reopens. I don't want to paint too rosy of a picture. Anyone who knows me knows that I spend a lot of my time focusing on risks and wondering, well, what if we're wrong? Where conventional wisdom could go wrong? So it's important to stay on your toes and to be able to weather some unexpected volatility. And there's a couple of main areas that we think could be a source of downside risk. One, inflation and higher yields aren't entirely off the table. The expectation is that yields are going to stay low for long, and inflation won't be a problem. Well, if that's wrong, that could have an impact on markets. And related to that is the size of the stimulus package. If it's much larger than expected, if the U.S. debt rises a lot larger than expected, that could cause inflation to spike higher. I'll also highlight the economy. Although the data is moving in the right direction overall, still not on a completely stable footing. We still have a long way to go to full recovery. And if you look at the employment market as an example, there are 13 million people there where their unemployment benefits are set to expire next month. So that's a concern. And finally, COVID cases are climbing in the U.S. and really across the globe. That's something to watch closely, and that's something that could dramatically impact the markets in a negative way. I mentioned Senate control is still undecided somewhat, and 2 more seats in the possible runoff. That's also a source of uncertainty, although I don't think it's a major risk either way. So the best advice for investors, I'll focus on 2 things. One, this year has been a great example of how investors can benefit by staying committed to stocks, even when things turn negative, even when the environment seems a little scary. You stay committed to stocks, and in this year, you've been rewarded for doing so. The other side of that is it's important to stay balanced. having something in your portfolio that can help stabilize and diversify the risk of your stocks going up or down is important, and it can help you stay invested. And more specifically about how balance is key, when we make portfolios for clients, we want to make sure that there's a portion of the portfolio that's poised to benefit when the economy and corporate earnings do well. And today, that means we want something that's going to benefit and grow when the economy reopens sometime next year. On the other side, we need and want something that's going to help us stay invested and get us to that point when we have a vaccine and the economy is fully open. So something in your portfolio should be able to withstand uncertainty. And combining those two in the ratio that's right for you is part of the job that we do. Shawn, I'll turn it back to you.
Thanks, Steve. So as you see here, we want to focus on what we can control. I talk to my clients about income, taxes, volatility, and risk. Those are things that we can control. Those are things and parameters we can work around. Short-term swings in the market clearly are hard to predict and plan for, which is why we don't do so, right? We look longer term, have a plan, create a financial plan that fits your needs, and ultimately work off of that document. It doesn't have to be a long, drawn-out process, but it could be as simple as, if you are saving enough, are there things we could be doing to take advantage of the current tax environment? Could we be creating certain gifting strategies for you at this point in time? Or if you are asking yourself, will this money last for me? We can validate that for you, go through the process, and help you sleep better at night knowing that a plan is on file, even if there is a long, drawn-out bad market in the future. Discipline is something we absolutely want to look at, and understanding that short-term swings, as we spoke about, can really hurt the long-term trajectory of your plan. So don't try to time the market, stick with the plan, make tactical adjustments as the market gives us opportunity. Manage the risk. The volatility is something we can certainly show you that you have inside of your portfolio. How much downside risk do you have? How much upside capture ratio are you exposed to? And does that fit the plan that we've created for you? The most important portfolio, or the best portfolio for you, is the one that we can stick to in both good times and bad. So it's very important to evaluate the risk and manage it with your advisor here at Signet. And then finally, expenses. Manage taxes, look at the turnover. What are the internal costs of any fees? Especially in the fourth quarter, now is a great time to review with your advisor. What are the capital gains that you've realized thus far? Are there losses, or are there things we can be doing before the end of the year to put you in the best possible scenario? Okay, and then with the Secure Act passing in December of 2019, the required minimum distribution age, meaning when the government forces you to take money out of your IRA, has been extended to 72. So that gives us a couple of years more to plan to potentially take advantage of lower tax rates. Let's look at when you plan to take Social Security, or if you're already taking it, where are you from an income standpoint? And if we expect tax rates to go up in the future, which many people are talking about because of the stimulus that we've provided, how do we best take advantage of that environment in today's market? Tax planning is something that we certainly want to look at. Partial or full Roth conversions may make a lot of sense for you, depending on your unique situation. And is there a way to achieve your financial goals, with lower risk? Again, let's look at the entire situation. Let's figure out how we make you pay at lower effective tax rates. And if rates are potentially going up in the future, let's pull money out of your IRAs now instead of being forced to pull money out later at potentially higher tax rates. So we encourage you to reach out to us, control what we have control over, and don't let the market in the short term dictate the long-term success of your plan. With that, Steve, there were a couple questions that were submitted to us prior to the webinar, so I'm going to read those to you, assuming that we have time here. So the first one I'll start with was what happens if in Georgia both Democrats win the runoff and then the VP gets the final vote?
Yeah, that's a great question. It's certainly still a possibility. I think it's not the consensus view. It's probably lower than 50% odds, but it's a possibility. I'll remind everyone that the blue wave scenario of Democratic control of the White House and Congress was the consensus thinking leading up to the market. So the market was already preparing for that scenario. We did see some rotation ahead of the elections, which was subsequently reversed. So if elections surprise the markets again with a runoff election in Georgia, we could see a little bit of volatility. We could see a little bit of movement, but I don't think it would be dramatic. And as usual, we have a plan for that. If you're a client of ours, your portfolio is designed to weather some uncertainty and some surprises. I wouldn't expect that scenario would be too dramatic of a change that markets couldn't quickly react to.
Perfect. Thank you. And then the second question, or the final question we'll ask is, why is the market going up now if the vaccine won't be ready for 6 months or even longer?
Yeah, that's another great question. But this is what you see time and again with markets. Markets are forward-looking. So when news hit the markets on Monday morning that a vaccine looked likely and the results were more positive than expected, investors didn't wait. They started to look into areas of the market that would benefit the most from the eventual vaccine being released and the economy reopening. So that's just a behavioral thing. But the other thing I will mention that it's not just the markets that move, it's also companies and individuals, their behaviors will start to change. If we believe that the economy is going to be reopened within 6 months, the idea of thinking about planning for travel becomes more real. Corporations can start to reinvest in their businesses again and to look to reopen various locations. So there's the market move, but there's also some real impacts and positive effects that you can see on the economy today as companies and individuals start to change their behavior and plan for better times. So I hope that answered the question.
Perfect. Thank you, Steve.
So with that, I just want to thank everyone for joining us. I hope the information presented here was informative. More importantly, I hope it perhaps sparked some questions or some areas that we might be able to help you with in terms of your financial life and achieving your financial goals. It's certainly a complicated time, and there's a variety of factors that are always changing. So if that's the case, please reach out to myself, to Sean, to your advisor. If you have any friends or family that you think could benefit from a conversation with us, we'd be happy to help them just like we help our clients every day. Thank you very much.